Silver dropped 8% in 48 hours. You saw the headlines. You watched the charts turn red. But here's what you didn't see. The real crash happened 3 weeks ago in the physical market. The paper price is just catching up to a liquidity trap that's been building since January. We're analyzing 3 public data points that predict Monday's open and how the sovereign ratio tells you exactly what to do before the bell rings. One of these data points suggests Monday could gap down another 5%, but the physical reality says something completely different. Download the source documents linked below so you can follow along with the data. Let's break down the 8% drop. Futures liquidation driven by margin calls and algorithmic selling. The narrative you're hearing everywhere is risk-off sentiment and dollar strength. That's not wrong, but it ignores the physical supply constraint that's been tightening for months. Now look at the EFP spread data from the CME Group's Friday settlement report. This is public information. They published it at 4 p.m. Eastern, and most traders scrolled right past it. An EFP spread measures the price difference between physical silver and paper futures contracts. Normally, the paper contract trades at a slight premium because it's more liquid. You can enter and exit a futures position in milliseconds. Physical metal takes weeks to move and costs money to store. But right now, the EFP spread is inverted. Physical metal is trading at a premium to paper contracts. That inversion widened to negative 47 basis points on Friday's close. Here's what that means in mechanical terms. When EFPs invert, it signals that physical delivery is constrained or impossible at current prices. The market is telling you that if you want actual metal, you're going to pay more than the spot price suggests. This isn't speculation. This is math. The paper price crashed because it had to. The physical market was already pricing in scarcity, and the futures market finally acknowledged reality. Think about it this way. If you can buy a paper contract for $29.50 per ounce, but physical bars are trading at $30.20 per ounce, what does that tell you? It tells you the system can't deliver physical metal at the paper price. The spread is the cost of that failure. Now, the mainstream narrative focuses on the 8% drop and calls it a crash, but the crash already happened when physical premiums started spiking in early January. The paper market just took longer to figure it out. Let me show you the timeline. On January 7th, physical premiums over spot were sitting at 4%, normal range. By January 21st, they hit 9%. By February 3rd, they crossed 12%. That's a 300% increase in premiums in less than a month. During that same period, the paper price was grinding sideways between $31 and $32. The disconnect was obvious if you were watching the physical market. But futures traders don't watch physical premiums. They watch technicals and momentum indicators. So when the paper market finally broke, it wasn't because of some new piece of information. It was because the physical reality became impossible to ignore. Margin calls, forced liquidation, and algorithmic systems amplified the move. But here's the critical insight. The paper crash is a lagging indicator. The physical market already told you what was coming. If you were tracking the sovereign ratio inputs, you saw this set up 3 weeks ago. The EFP inversion confirms what the physical premiums were already screaming. There's a liquidity trap forming, metal exists, but it can't flow to where demand is concentrated. And that brings us to what happened in London while New York was selling off. While New York was selling off, London was bleeding inventory. Pull up the LBMA vault data for January 2025. Net outflows of 2,400 metric tons since December. That's 77 million ounces leaving the system in 6 weeks. Now here's where the two-wallet analogy becomes critical. Imagine you have 2 wallets. Your left pocket, let's call it London, is completely empty, and you've got a bill due that you need to pay immediately. Your right pocket, New York, is stuffed full of $100 bills. Normally, you'd just move some cash from your right pocket to your left pocket and solve the problem. But what if it cost you $47 to move $100 from one pocket to the other? You wouldn't do it. You'd leave the money where it is and figure out another way to pay the bill. That's exactly what's happening between COMEX and LBMA right now. The cost to move silver from COMEX to LBMA has spiked to 0.47 per ounce. That includes shipping, insurance, refining to meet London good delivery standards, and the time cost of capital. At current spot prices around $20, that's a 1.6% friction cost just to move metal between exchanges. Normally, that arbitrage opportunity would be profitable. If London prices are higher than New York prices by more than the transport cost, traders would move metal and capture the spread. That's how the global market stays aligned. Arbitrage keeps prices in equilibrium. But right now, the spread isn't wide enough to justify the move. London premiums are elevated, but not elevated enough to cover the 47 transport cost, plus the risk of further price drops during transit. So the metal stays in New York, and London keeps bleeding inventory. This is what I call a physical liquidity trap. Metal exists, but it cannot flow to where demand is concentrated. The usual mechanism that keeps prices aligned between exchanges is broken. Now look at what happened on the COMEX side during January. Registered inventory dropped by 18 million ounces. Registered inventory is the metal that's available for delivery against futures contracts. It's the actual physical backing for the paper market. Let's do the math. If registered inventory continues declining at this rate, COMEX will hit critical levels by March. The threshold that historically triggers delivery concerns is around 50 million ounces. We're currently at 68 million ounces. At the current burn rate of 18 million ounces per month, we're 2 months away from that threshold. What happens when registered inventory hits critical levels? Historically, we see one of two outcomes. Either the paper price spikes to ration demand, or the exchange changes the rules to prevent a delivery squeeze. Both outcomes are bullish for physical holders, but the path to get there can be volatile. Here's the hard data. The crash in paper price is a symptom of a system that can't deliver physical metal at these levels. The EFP inversion tells you the futures market knows this. The LBMA outflows tell you the physical market knows this. The only question is what happens when the registered inventory hits the critical threshold. This brings us to Monday's open and what the sovereign ratio is telling us right now. Let me define the sovereign ratio for anyone new to this framework. It's the balance between physical assets and paper liabilities, adjusted for liquidity and delivery risk. This isn't a theoretical model. It's a tactical tool that uses real-time data to tell you when to shift capital between paper and physical positions. The current sovereign ratio inputs are telling a clear story. Physical premiums are at 12% over spot. COMEX registered inventory is at 68 million ounces. Lease rates are at 4.2%. These are the three primary inputs that drive the calculation. Here's how the threshold works. When physical premiums exceed 10% and registered inventory drops below 70 million ounces, the ratio signals a tactical shift toward physical allocation. We've crossed both thresholds. This is not speculative, this is math. The 10% premium threshold matters because it represents the point where physical supply constraints become systemic rather than temporary. Below 10%, premiums can spike due to short-term demand surges or logistics delays. Above 10%, you're looking at structural supply issues that take months to resolve. The 70 million ounce registered inventory threshold is based on historical delivery patterns. When registered inventory falls below that level, the ratio of open interest to available metal creates delivery risk. Right now, open interest in the March contract is 142,000 contracts. Each contract represents 5,000 ounces. That's 710 million ounces of paper claims against 68 million ounces of registered physical metal. The ratio is over 10 to 1. Now let's talk about Monday's open. Based on Friday's settlement data, I see three possible scenarios. Scenario A, gap down to 28.50 if margin liquidation continues. This is the paper-driven outcome. If leveraged longs keep getting forced out, the algorithmic selling could push us down another 5%. This scenario assumes no physical buyers step in and futures traders keep hitting bids. Scenario B, flat open with tight range if physical buyers step in. This is the equilibrium outcome. If industrial users or large physical buyers see $29 as an opportunity, they could absorb the selling pressure. We'd see a choppy open that grinds sideways between $28.80 and $29.50. Scenario C, gap up if a large physical buyer emerges over the weekend. This is unlikely but possible. If a central bank or sovereign wealth fund places a significant physical order over the weekend, we could see a short squeeze on the paper contracts. This would look like a gap up to $30.50 or higher. Here's the sovereign investor's move. Regardless of Monday's open, the physical reality favors accumulation at current levels. The EFP inversion and the registered inventory decline tell you the system is under stress. When systems are under stress, physical assets outperform paper claims, but risk management matters. Position sizing should account for further paper volatility. If you're increasing physical allocation, don't go all in on Monday morning. Scale in over the next 2 weeks. Use paper weakness to dollar cost average into physical positions. The long-term setup is intact. The physical supply constraint isn't going away. Industrial demand isn't going away. Central bank buying isn't going away. The paper market can stay irrational longer than you expect, but the physical market doesn't lie. The tactical play is straightforward. Use this paper crash to increase physical allocation while maintaining dry powder for further volatility. The sovereign ratio is telling you to reposition, not to panic. Let's zoom out and look at what this means for the next 30 days. The March COMEX contract rollover is the next critical date. This happens in 3 weeks. Watch for delivery notices and registered inventory changes during that window. The rollover period is when we'll see if industrial users are willing to stand for delivery or if they're content to roll into the May contract. Historical pattern shows us what to expect. When registered inventory drops below 65 million ounces, we typically see a 10-15% rally within 45 days. The mechanism is simple. As available metal declines, the futures market has to reprice to ration demand. Either longs take delivery and drain inventory further, or they roll forward and create a backwardation in the curve. The current setup mirrors October 2023. We saw a similar EFP inversion back then. Physical premiums spiked to 11%. Registered inventory fell to 62 million ounces. What followed was a 22% move in 6 weeks. The paper market caught up to the physical reality, and late buyers paid significantly higher prices. But this time could be different for one specific reason. Central bank buying has accelerated. The World Gold Council's Q4 report shows net purchases up 40% year over year. Now that data is for gold, not silver, but the buying behavior signals a broader shift toward physical monetary metals by sovereign entities. If that trend extends to silver, the supply constraint becomes even tighter. Here's the industrial demand floor. Solar panel production and EV manufacturing create baseline demand of 600 million ounces annually. This is non-discretionary. These industries can't substitute away from silver without redesigning entire production processes. That takes years. So even if investment demand collapses, you've got a hard floor of industrial consumption that has to be met. The tactical play for the next 30 days is straightforward. Use paper weakness to increase physical allocation, but maintain dry powder for further volatility. If we get scenario A on Monday and the price gaps down to 28.50, that's an opportunity to scale in. If we get scenario C and the price gaps up, let it run and wait for the next pullback. Current sovereign ratio inputs suggest a 60-40 physical to paper allocation for tactical investors. That means if you're holding $100,000 in precious metals exposure, $60,000 should be in physical bars or coins, and $40,000 can be in paper instruments like futures or ETFs. That ratio shifts as the inputs change. Key risk to watch. A coordinated central bank intervention or a surprise COMEX rule change could alter the timeline. The exchange has changed margin requirements and delivery procedures in the past when supply got tight. If they do that again, it could delay the physical squeeze, but it doesn't eliminate it. The final insight is this: the crash already happened in the physical market. The paper price is just catching up. The EFP inversion, the LBMA outflows, the registered inventory decline, all of these data points were published weeks ago. The information was public. Most traders just didn't read it. The paper crash is real, but the physical reality is telling a different story. Adjust your sovereign ratio accordingly. Download the CME and LBMA reports linked below so you can verify the data yourself. Subscribe for the Monday morning update, where we'll analyze the open and adjust the tactical outlook in real time.